A very good morning to all our viewers who've tuned in live to this broadcast here on Moneycontrol. You're watching Opening Bell with me, Stacy Pereira. Let me quickly give you a recap of where we left off with trade yesterday. Managed to close above those 23,300 levels finally, because in the last hour of trade is where we are really, seeing that pressure building up when it comes to the selling bit in trade, especially for the benchmarks. But the broader indices still managing to hold out, we would say. But of course, today's day is going to be about all the data digesting. We've had the CPI as well as IIP data that came in for India for the month of May. And we also have the US CPI data that came in much better than expected, and of course the FOMC decision from the Fed where they've left rates unchanged and also signaled just about one cut this year. So we're going to be discussing all that, and of course how stocks are going to be reacting to all of this news, and a whole host of other stocks that have come out with brokerage notes on. All of them we're going to be discussing with our experts. But before that, let me take you through all the top headlines. Now, the US Federal Reserve has posed Wall Street and has left rates unchanged. The shift in the dot plot is what will get people interested, because it has projected just one rate cut this year. Jerome Powell, the chairman, also rules out any hikes ahead and seeks more confidence and data on the inflation before any cuts. CPI inflation for the month of May in the US has come in lower than expected at 3.3%. And Asian markets have risen following that strong handover from Wall Street. The GIFT Nifty is also suggesting a higher start for the Indian equity market. Crude prices pair their gains on an unexpected rise in US inventory, with Brent hovering around that $82 a barrel. Gold, on the other hand, too remains range bound after the Fed says that it expects to cut rates only once this year. India's retail inflation, or CPI, has eased to 4.75% in the month of May. Core inflation also cools to about 3.1%. Even food prices remain stubborn. Industrial output, on the other hand, in the month of April remains quite steady with a 5% growth rate. And around 40 Indians have lost their lives and other 50 injured in a blaze that occurred in a labor housing facility in Kuwait. Meanwhile, 2 Indians who were recruited by the Russian army have also lost their lives in the conflict in Ukraine. The Indian government takes up the matter strongly with Russia and calls for the early release of all Indian nationals in the Russian army. Well, just about 10 minutes to go there on your screens, and we'll know the direction, whether we can manage to, get past that 23,300 levels and higher, because yesterday we did manage to create that new high, but whether 23,500 is now in sight is something that we're going to be looking at. But if you have to go by the FNOQs, well, according to the weekly options data, 23,500 was that maximum open interest strike that we saw for the call side of it, with a combine of 1.5 crore worth of contracts that came in for that 23,500 strike. On the put side, we did see the open interest maximum for the 23,000 strike at 73 lakh combined open interest contracts. So the put call ratio then goes on to show that it is remained steady this time around at about 1.02 level. So that's where you are with the PCR. But if you talk about the FNO band, a couple of stocks that continue to remain in the band are Hind Copper, GMR Airport Infrastructure, India Cement, Balrampur Chini, as well as SAIL. Removed from this list now is Z Entertainment Limited. So that's the one stock that has come out, with the other 5 continuing to remain in that FNO band list. When it comes to the fund flows that we saw yesterday's trade, about FIIs went on to buy about 426.63 crore worth of shares, whereas the DIIs also did some bit of buying. They bought in 233.75 crore worth of equity shares. The INDIAVIX index, now that one is giving some comfort to the bulls. In fact, on the Lal Street, we could say, because that fear index now has closed lower by 2% yesterday, coming below that 15 levels, closing in at 14.39. So that's pretty much where we stand with the setup for today's trade. But of course, let's discuss that big Federal Reserve in the US and its FOMC's decision, and how that could really go on to change and impact. Of course, we are seeing the US yields as well as the dollar index react to that quite sharply, but they have gone on to keep those interest rates steady, the current range at that 5.25 to 5.5%. The outlook for these rate cuts is also just one for the year of 2024. Now, the policymakers definitely did note that they are seeing some modest further progress when it comes to inflation and getting that to that 2% objective that they have kept it at. Now, Jerome Powell also noted in the press conference later that the central bank does not yet have the confidence to cut rates even as inflation has eased from its peak levels. In fact, the Federal Reserve's latest dot plot projection showed that only 1/4 point rate cut, so just 25 basis cut, is what we're going to see in 2024, down from the earlier forecast which said that there could be multiple rate cuts. Let me go across to Peter Cardillo then and try and understand what he's making out of the statements that came out of Fed Chairman Powell's press conference, as well as the fact that the dot plot has changed now. How much does it make a difference really?
Well, there's no doubt that the Fed took a cautious outlook, and they basically said that they're going meeting by meeting, which means data dependent. As you alluded to before, the CPI came in cooler than expected, and in fact, the core rate was better than expected. And so I think that signals that the recent hikes that we saw in inflation since last December may have peaked. And so that's a good going forward. And I think that despite the fact that the dot plan projects one rate cut this year, I think that if we get good news on inflation in June and July, that we'll probably see 2 rate cuts, one in September and one in December.
Right, so you are still hopeful and you're thinking that there could be 2 rate cuts in fact, but he's also pointed out the fact that unemployment still remains low, and that is a worry. Do you think that is enough for the Fed to actually take a more cautionary stance? And how are stocks in the US have pretty much shrugged off any of this because they say that was already factored in. How do you think the markets there are going to take this going ahead if there are any changes and we are surprised and see this perhaps no rate cut at all in this year?
Well, the labor market is still pretty much tight. It's still producing jobs. We saw that last week. But the key is obviously wages. And if you look over the past 2 months, hourly wages were up rather modestly. And if that trend continues, despite the fact that unemployment is at 4 and it might just tick up a little bit higher, which signals still a healthy labor market, I think that would be a good motivation for the Fed to say, well, labor inflation is not going to be a problem, combined with the fact that energy prices have not really gone up that very much. In fact, they're basically stuck in a trading range. And so I remain optimistic that despite employment growth, that the Fed is likely to cut 2 times this year. Now, of course, if inflation should reverse, then I'm going to be wrong. And the possibility of 0 rate cuts still prevails. But based on the data on inflation and the labor market so far, I think that things are moving in the right direction for the Fed. Of course, there are other indicators, which some are strong and some are weak. But by and large, the economy looks like it's going to end up the year growing somewhere between 2.25%. And if you have inflation moving in the right direction, I think that's the perfect subscription prescription, I should say, for the Fed to give us at least 2 rate cuts.
Right. Peter, finally, how would you really see this trickle down to the emerging markets, or for funds that are waiting to come into some a country like India. How do you think, maybe a delay or the fact that there are no rate cuts or a delayed one is going to change about what happens with the emerging markets and the funds waiting to come in here? And also, the Indian IT sector, how does that really get impacted? Because a lot of that does matter with the Fed's decision.
Well, there's no doubt that the Indian economy is doing quite well, and I expect that to continue. Inflation somewhat sticky, but again, if we see inflation coming down in the States, and by the way, it's been somewhat more modest in the Eurozone, that will affect the emerging markets as well. And of course, again, the key remains to commodity prices. Countries that are subject to that their growth is subject to commodities. Obviously, energy, number one, especially in India, will make a big difference. So if we don't have a spike up in energy prices, I think it's safe to say that emerging markets, that is the more settled emerging markets, will probably follow suit with inflation coming down.
Right. Well, thanks so much there, Peter Cardillo, giving us his perspective on how the latest FOMC meet and the outcome from the Federal Reserve, keeping rates unchanged. But thank you so much, Peter, for joining us this morning. Well, let's also get a sense then about how the Indian market is going to be reacting to all of this. We also had our own inflation number that came in much easing, we could say, coming at 4.75 versus the 4.83 that it was a month earlier. But it will be interesting to see. We managed to close about that 23,300 levels yesterday, but what's going to be taking it further, or is there enough catalyst, and what will be that catalyst? Let me go across to Osho Krishan. He's joining me now. He's a senior analyst at technical derivatives at Angel One. Good morning, Osho. Always a pleasure to have you with us here at Moneycontrol. We are looking at what markets have done just this week. If you have to say, it was starting with some bit of negative or consolidation, we could say, not managing to close above that 23,300 levels. Now we finally managed to break past that and also close above that higher highs that we are seeing every other day when it comes to the benchmarks. Can we say that we are headed towards 23,500 sometime close, or there will be more consolidation first before that next leg up? What are you reading on the charts?
Very good morning to you, and thank you for having me at your show. Now, coming to the query, we are already witnessing a very strong opening for our market, nearly 23,480 on the spot levels that is expected for the Nifty to open. So that's a very positive trigger for our market. Well, basically the domestic macro data and even the positive or favorable global data both have provided very strong thrust to our market. So we are expecting that the undertone should remain very bullish. But looking at the recent developments in the last two trading sessions, there has been very strong consolidation in Nifty. So we are expecting that on the lower end, 23,200 and 23,300 should be acting as a very strong support zone for any kind of dips. Should be auguring very well for the buyers. While on the higher end, as you have already mentioned at the start of the show, the 23,500 has a very strong piling up of call writing position. So that can be seen as a very strong hurdle for the timing. But the time it surpasses the zone, we can witness another 100 to 150 point of rally in Nifty.
Osho, I'm just going to have, you'll have to hold your thought there, because we'll address the market opening, the ticks that are coming in for all of our indices. And if you look at the GIFT Nifty, it was indicating that 23,400 above levels, and that's where the Nifty 50 has opened above about 110 points, that it has got almost close to 0.5% of gains that you're seeing on the Nifty. So we are starting with that good positive momentum. So for the sensex as well, close to 0.5% of gains coming in right at opening. We're managing to touch that 77,000 levels as well. So it is going to be oscillating between that, but you are going to see the sensex Nifty comfortably there with 0.5% of gains coming in right at opening bell. Your broader indices also enjoying that kind of momentum or the push, almost close to 1% of gains coming in for the Nifty mid cap, and it has been touching new record levels every other day. So the mid cap and small cap index, both of them comfortably there. The small cap index almost close to 400, above 400 points that it has gone right at the opening bell. The bank Nifty also there above that 50,000 level, so that is something. 50,100 in fact is where it's trading at. Quite good positive push coming in there for the bank Nifty as well. In fact, let's get into the details of which are the stocks that are really contributing to all of these gains. And yesterday we did see a lot of these stocks, be it from the banking, the heavyweights, really seeing some bit of selling pressure towards the end, but we did manage to hold out. And here the bank Nifty seeing some almost close to 200 points there on the bank Nifty. So let's look at the gainers, losers then on your screens, and who's really contributing to these to the the run up or the rally that we're seeing, or this gap up open for the Nifty. You have Nestle India from the FMCG pack, but this is also because there is news flow coming in from there that Nestle is going to be giving the royalty to its Swiss parent in the same level that it was doing before. You have LTI, Mindtree, as well as Divi's Lab from the pharma pack that is making it among your gainers. You also have Wipro, Ultratech, Infosys. So Wipro, Infosys interesting because your IT stocks are definitely going to see some good bit of momentum now that you have the Fed meet out of the way. Ultratech Cement also has some news flow that is coming in from the whole cement sector, and we'll be discussing that in detail. Hindalco also there coming in from the same pack. You have M&M from the auto basket as well as NTPC among your gainers. Let's look at the flip side, and it's perhaps going to be a lot of insurance companies that we could see negative news flow coming in there. But you have Britannia and HUL as well as Tata Consumer. So all your FMCG pack up there in the negative today. So all of them succumbing to pressure, or the selling pressure and the run up that we have seen so far in all of these stocks. So you have HUL, Britannia and Tata Consumers among the losers. Let's look at the other ones that are also going to be making it there. And like I said, there could be pressure coming in for life insurance companies or insurance sector because there's news flow on that. But first, let me go across to Osho again and get a quick word on the indices and the fact that we are touching newer highs each and every day, even for the bank Nifty for that matter. What would be your strategy for the index, both the Nifty as well as the bank Nifty, now that we are on newer highs?
See, for Nifty, I will be waiting for the market to get some kind of cool off or some kind of stabilization by the first half an hour to 1 hour, because the very strong support lies around 23,300 odd level. So if there will be any kind of dip towards the last closer, then that should be auguring very well for the markets. So there one can try to have a gauge momentum on the long front. While for bank Nifty comparatively is a bit more strong as compared to Nifty. From here onwards, I am expecting bank Nifty to test 50,500 levels on the higher end, because positionally it is placed at a very decent levels, and even from risk reward ratio there has been a very strong formation around 50,500 followed by 51,000 call writing, while on the lower end 49,500 has a very strong put writing also. So one can expect that if there will be any kind of dip in, let's say, another half an hour or 1 hour kind of a trade towards 49,900, then that should be auguring very well, and one should try to accumulate bank Nifty at those levels for higher target of nearly 50,300 to 50,500 for the day.
So for the day that it is, you can wait for it to go below that 49,900 odd levels and then look at the bank Nifty again. But Osho, do stay on with us. We will get to a couple of queries that we'll have answered. But before that, let me also tell our viewers about a block deal that could be brewing, and this coming from L&T Finance. Now we are given to understand that the sellers could be Bain Capital affiliates. This includes Bain Capital's Asia Investment Fund, the Asia Growth Investment Investment Fund, as well as BNP Paribas and SNC. This could be the size of the deal could be somewhere around 3.54% of total equity that is looking to be paid off. The deal is clean up trade. They say the base price of about 169.17 per share. This is barely a discount, we would say, to where the stock is trading right now. So that's where this block deal could be taking place, or perhaps have happened in that window. Now this is a discount is, of course, like I said, less than 1% to the closing price, so which means that that base price, or if you look at the total deal price, will be a little more than 1,500 crores if you have to look at L&T L&T Finance at this point. But let's also get our viewers up to speed with what's happening in the insurance front, like I was pointing out. Now IRDAI has come out with its diktat on the whole surrender payouts, surrender value that insurance companies have to pay out, and now they've gone on to say that policyholders will get that higher special surrender payout on their early exit from that endowment plans. Now this, of course, doesn't augur so well for your insurance companies, and in fact Morgan Stanley has said that the revised surrender value norms will appear quite a negative versus the norms that were proposed back in March, which were likely manageable. So now this special surrender value regulations are in line with what news reports were talking about, but it will go on to impact the net VBN margins for sure, in the negative sense for that matter. And also the initial conversations did suggest that insurers will now go on to take actions to mitigate this, or to try and lessen that value. They're of course also still awaiting more commentary on how individual companies react to this. If you look at Jefferies, they say that for life insurance these new SP norms are pretty much in line, but will also be applicable only from October 24. So there is some time for them to come out and give more clarity. The higher surrender value can, of course, lower the product's gross margins by close to 6 to 8 percentage points is where they are factoring this impact to be at, whereas life insurances can limit this impact to about 40 to 120 basis points by deferral or clawbacks or a cut in their commissions as well as rates. So this could be a step that you could see insurance companies take, but it will still impact them somewhere to 40 to 120 basis points, whereas the impact will be higher for companies like Max as well as HDFC, and lower for companies like ICICI Prudential as well as SBI Life. This because of the non-participatory as well versus participatory from these kind of companies when it comes to the insurance sector. They do say that it's manageable impact and can abate concerns as well as aid a re-rating for a couple of these stocks. Osho, quickly your view on life insurance companies, and given this given this news flow that has come in, which of these companies you think still has value, one needs to be looking at with a more cautious view?
Looking at the overall setup of major of the insurance companies, they have totally shrugged off the news, because looking at the momentum that all the counters are witnessing are very positive for the day. And from here onwards, even I have a very bullish view on SBI Life, because these things has already been factored, because in the last 3 to 4 months there has been a decent correction while the market were having a very higher highs, higher lows kind of a pattern, but insurance companies were already in a very downturn or corrective phase. So from here onwards, there can be some kind of breather that can be seen in major of the counters. Specifically, if I have to identify, then SBI Life is at a very lucrative level from risk and reward point of view. It has hovered around the 200-day SMA in the last 2 to 3 trading weeks and has started gaining traction. So I'm expecting that in the coming week, not a very aggressive on the targets, but there will be a gradual up move that can be seen in some of the counters like SBI Life, HDFC Life. These two counters are looking very positive because they were already in a very down run. So I am expecting that there can be a gradual up move of approximately, if I have to be level specific, then 1520 for SBI Life in the short term period.
pretty much shrugging off the news like Osho was pointing out. But let me also get a broader perspective on how the Indian markets are trading currently, and what is the strategy one could really adopt in this kind of scenario. We do have the general elections that are out of the way now. We also have the MPC that has pretty much maintained status quo and is taking cues, we would say, from what is happening globally. So where we stand as of now with how the Indian markets are awaiting some kind of trigger. Of course, we have the budget that we can look forward to, and a lot of answers that we're really seeking through that one. But let me now bring in my next guest, Kunal Valia. He's the founder at StatLane, who's joining me now. Good morning, Kunal. Always a pleasure to have you and people give us their perspective here on the show. What I'm really looking at today, because we had such a big heavy data day all of yesterday, and getting in all what the Fed has done and what the Indian markets reacting to it, or rather not really having much of a reaction. But often we talk about how the IT companies really go on to get impacted, or will we see some kind of change when or whenever that rate cut comes. But do you really think that now that we have that sense that there's going to be only one rate cut, how much of that is really going to change for emerging markets like India? Do you think we are on our own and we have enough and more ammo with us that we don't really need to be looking for these cues?
Sure. Good morning. Let me just give you a global perspective in terms of how things are likely to pan out for rest of the year and the 2025 scenario. Global growth inflation dynamics definitely are turning in favor of lower rates and dovish policy stance by central banks. So that is going to be working for the markets, whether it is bond market or equity market. It is in favor of that. We already have seen 4 central banks, Sweden, Switzerland, Canada, as well as the ECB, starting the rate cutting cycle. Yesterday's data print, as you mentioned, the CPI data in US has been quite encouraging over the last several months. The trajectory has been lower, and the yesterday's print came in lower than expected as well. The Fed meeting unanimously kept the interest rate unchanged. What we further saw was the growth projection as well as the unemployment projection by the Fed for rest of 2024 remain unchanged. Let me give you some data as to what was mentioned by the Fed. The GDP, the real GDP number, they are expecting it to be around 2.1%. They have maintained the same compared to the March outcome. The unemployment number at 4% also remains the same in what was mentioned in the March outcome. What was a little bit surprising is that the inflation trajectory now Fed is expecting a little higher. The PCE inflation number is expected to be 2.8% compared to 2.6%, which was mentioned in March. What has moved, or I would say the turn the corner, is that in March, the Fed was talking about 3 rate cuts in 2024. Yesterday, that entire trajectory has now shifted to 1 rate cut. So it's a pretty, I would say, a dynamic stance which is taken by Fed, which is largely data dependent. Suddenly, we will see the unemployment number going up and the wage growth falling or being less than estimated. We may see 2 or 3 rate cuts as well. But again, this is going to be a very data dependent approach by most central banks, as they are afraid of the scenario which panned out in 2022 and 2021. What is interesting is that given where we are, for example, 2024 1 rate cut, 2025, interestingly now they have moved to 4 rate cuts from 3 earlier. So again, the scenario overall looks pretty dovish, and we have to remember the fact that after a very long period of time, both in US and Europe, we have a positive real rates, which was not the case for almost 10 years. So there is reasonable headroom available for both ECB and the US Federal Reserve to embark on a cycle of a significant rate cuts, possibly in excess of 125 to 150 basis points over the next 12 to 18 months. The way the interest rates which are panning out, or the yield curve which are panning out in years, is also telling us something that most people are got it wrong. The yield inversion theory, which is a lot talked about between the 2-year and the 10-year bond yield, being the 2-year bond higher than the 10-year bond yield, always leads to kind of a recession over an 18-month period and so on and so forth. So we are past that almost now 2.5 years since the time the invasion started, but there is no sign of any recession in US. So that theory actually has not worked for the Fed or for the market analyst as well. So we are in a scenario where a lot of things are very, very dynamic in nature. But one thing is very sure is that we are moving towards a very low interest rate cycle. What it means for emerging market is that emerging markets will have a little headroom for bringing down rates to push up growth, as possibly we will end up into a more sluggish growth in some parts in emerging markets as well. Coming to India, possibly 2024 calendar year may not be a year where we will see RBI may act aggressively. There may be possibly one token rate cut, or possibly to start with, there will be easing of liquidity, which has been not the case so far over last 18 months. So RBI may start with easing of liquidity, and 2025 we will see a reasonable rate cut from RBI as well. Whether India stands on its own, currently we have very stable foreign exchange reserves with us, despite FII selling continuously over last 2 odd months, or in fact since 2021, last part of the months, FIIs have been sellers of Indian equities, but still we have a reasonable foreign exchange available. Secondly, the current account deficit is largely under control, given that oil is something which is not spiking and pretty stable at this point in time. All these points are auguring well for Indian markets as such, but I think there will be more action in Indian bonds going ahead. The FII inflows, which talked about, JP Morgan inflows, and so on and so forth. So bonds are looking more positive relative to equities, given where the valuations are.
Right. In fact, we are seeing that even in terms of where people are parking their money, because we are seeing money getting into the debt a bit of the market more than compared to the equity. Well, do stay on with us, Kunal, and I'll get back to you in a bit. But let me also address a couple of brokerages that have come out. One, Morgan Stanley's report on Infosys, and it's quite interesting because now they have an overweight call with a target of 1,650 per share. They say that the status quo in discretionary demand, but that doesn't really change much for the company. The deal pipeline remains strong for Infosys, as well as the deals won in the recent quarters are converting now into revenues, and which is why they are confident that especially their Project Maximus, which will go on to support its FY25 margin outlook. So that is Morgan Stanley's call on Infosys, and you can see the counter pretty much up and about. You also have another report that has come out on Trent, and this is quite interesting. This is an overweight call by Morgan Stanley again on this particular counter with a target price of 4,812 per share. They've said they witnessed record footfalls across the stores, and in fact their store Zudio is on the journey to becoming one of India's biggest lifestyle brands. Star Bazaar will be the third engine of growth for this particular company, and about 20 to 25 new stores in FY25 is what the company has planned out, and there is no plans of any demerger in the business given the back-end integration of all these different formats. They will enter international markets as well as by opening a handful of stores, is what the company has indicated, and which is what the brokerages are quite positive on Trent as well. Osho, quickly coming to you, how are you looking at this particular counter, and is there enough, like how the brokerages are pointing out, does Trent have enough value or entry points currently that one should be looking at it?
See, overall this counter is overstretched. Talking about the technical developments, the major of the technical indicators are nearing the overbought territory, but looking at the historical move and it being consistent with the cycle of higher highs, higher lows, I am expecting that this should continue, but one should not be very much aggressive if one wants to enter at the current market price. But if someone is already holding the position, they should stay intact with their investment, with stop loss kept around the zone of 4,600 odd levels. But for some people who wants to have some fresh accumulation in this counter, better to wait for some kind of dip towards 4,600 odd levels. Then one can definitely try to accumulate for short to medium term perspective.
Well, let me quickly also get you to answer a query that is coming in from Pon Rajesh. He wants to know your view on Lemon Tree Hotels. How is that looking? And since we're talking about mostly our discretionary part of the markets, hotel stocks have seen quite a bit of momentum, and in fact people say that that is something that might not change so much when it comes to the hospitality and aviation sector. Would you also agree, and also help out Pon Rajesh here with what are the charts saying on Lemon Tree Hotels?
So overall hospitality sector is looking very bullish to me. Overall, in the last couple of trading months, there has been very strong movements in major of the hospitality sectors and travel related companies. But looking at the technical charts of Lemon Tree Hotels, then from here onwards, there is some kind of consolidation near the zone of 145 to 150. But the time it surpasses the zone of 150, then we can see some kind of strong traction coming in for higher targets of nearly 165 for short-term perspective. But from medium-term time frame, the cycle of higher highs is staying intact in this counter, and one should definitely stay invested for medium-term time frame. The higher targets comes around once it surpasses the zone of 165, then one can definitely eye for 170 to 180 points in the medium-term time frame.
So definitely stay invested in Lemon Tree Hotels is what we are suggesting, for that particular counter. But Kunal, finally to you, which are the sectors you think we've been talking all this while because we had the election, so we saw a whole host of PSU stocks really rally and then take a drubbing on that counting day. But beyond that, now, now that we are past with the outcome of the elections, we do have the budget that is coming up. Do you think PSU still merit and there is enough pockets and sectors within the PSU pack that you see value in, and what would those be?
While it will be sounding like a contra bet, I think IT and chemicals are two key sectors which have seen a significant de-rating by the market, given the growth issues as well as the profitability issues and margin issues. We believe that the PSU theme may continue to play, but I think one has to be extremely selective about what they are buying in the PSU space, because some of the counters have been just one-way ride for the markets, and it has been looking so easy for investors. But going ahead, I think we need to be very selective when it comes to counters on the PSU side. We see value in capital goods, manufacturing as well, because the thrust is going to be largely making India one of the larger centers in terms of the manufacturing base for the world. So on the private side, manufacturing companies continue to remain a good bet. PSU, we would be very, very selective. IT and chemicals is something where we would like to be participating and accumulating over a period of next 3 to 6 months.
Right. So interesting picks that you have there. Quickly, Osho, to you, any stocks that are on your radar or that you would want to recommend our viewers today? Anything that in particular is looking interesting to you?
See, overall, there are various counters which are looking very positive and seen a very strong breakout in the last trading session. But the first one from the gas distribution is IGL. IGL has seen a very strong traction in the recent period, and it is about to give a very strong breakout at the current level. So one should try to accumulate this counter at current zone for higher targets of nearly 500 followed by 520 in short-term perspective, positional basis, let's say 2 to 3 trading sessions. While on the lower end, 462 is a very strong support zone, and one should keep this as a very strict stop loss. The other counter which is looking very positive to me is from the mid-cap IT sector. Emphasis is looking very positive. It is hovering near the cluster of its moving average, and I am expecting that in the coming period, IT sector can gain some strong traction from here onwards. Even from risk reward point of view, emphasis has a very strong or at a very lucrative levels with a decent risk reward ratio. So one should try to accumulate the momentum in emphasis for a higher target of nearly 2500 followed by 2540 in the short term period, while it is advisable to keep a stop loss around 2360.
So emphasis and IGL are Osho's pick. Last question to Kunal then, and I want your view particularly on new age tech companies. There is some news flow coming in from Paytm where it is going to be looking at the insurance business. In fact, they have registered their withdrawal for the plea they had put in earlier. But there has been quite a bit of news flow when it comes to Paytm in general, but also so has there been brokerage notes on Zomato as well as Nykaa and the likes. How are you viewing them, and do you think there is merit to be looking at these, or do you have a different view on them?
So we prefer to stick to standard companies compared to the new age tech companies when it comes to largely overweight, underweight positions. We prefer to be extremely careful about the valuations which are there in the market right now. So if a new age tech company is available at a reasonable valuation relative to some of the old companies which we have in our portfolios, we prefer to stick to the older ones, standard stories right now, given where the valuations are at. But yes, a valuation correction in prices, etc., we definitely will look at to add some of these companies.
Well, interesting take there then on these new age tech stocks. Well, we're completely out of time this time, so let me thank both my guests, Osho Krishan as well as Kunal Valia, for giving us their time and speaking with our, helping our viewers with their queries, and also to all our viewers, we'll do try and take up your queries as and when we can and have these experts answer them for you. But for now, we're completely out of time, so it's a goodbye and thank you from the entire team that puts this piece together. Keep watching Money Control. Send us your feedback in the comment section below, and also like and subscribe to our Money Control channel for all your other updates. Stay tuned to moneycontrol.com as well as the Money Control app. I'll be back tomorrow.